You saw recently, many companies which were trading at prices which was very difficult to justify. In fact, in the Indian market, people explained that strategy, and some of the fund managers who followed that strategy are quite embarrassed about it. They have been hurt. They have been very disappointing. They made a name for themselves, and it had a good run in the initially. And it's a very interesting name called BAP. Buy at any price was the expression used for their strategy. They thought that here's a great company which is doing very well. The market was completely opaque. Most of the brokers were crooked guys. They always bought at the peak. You always sold at the lows.
So if you are to help someone in their 20s who has just started building their portfolio, what are some 5 things that they necessarily have to check when they are picking a mutual fund?
Do only SIP. Never invest lump sum.
Are you looking to build long-term wealth through mutual funds but are confused by the thousands of schemes in the market? Are you trying to figure out where to start? Well, in that case, you're lucky because in this episode of Finshots Money Playbook, we are talking to Dhirendra Kumar, the founder and CEO of Value Research. He's going to tell us the ins and outs of the mutual fund market, so stay tuned.
So I'll just dive into the questions. You've been one of the largest proponents of mutual funds and how they can help someone in building real wealth. But then when someone who is new to finance just comes upon, opens Value Research, for example, and they come across so many choices. There's small cap, mid cap, large cap, there's sectoral, thematic, etc. It's so overwhelming for someone who does not know a lot about this. So what do you suggest to a person who is just starting out? And another question attached to this is, do you think that this industry has fallen into this trap of too many options?
Yeah, undoubtedly, there is a problem of plenty.
Okay.
Mutual funds were supposed to simplify people's life. They were supposed to, make it easy for you to participate in the market, But mutual fund is actually, people think that mutual fund is an asset class. It is not. It is a means, it is a vehicle to invest in equity, invest in debt, invest in international market, invest in a combination of things whereby it reduces your risk. So it's a vehicle which by combining assets in a diversified portfolio in a simple way is able to deliver you an experience which is very different from stocks, while the underlying is stock. Yeah. So, and that is very crucial for individuals. So at the end of it, it is a consumer product. And if you go and go to buy shampoo, you have the same problem. Dry hair, dry scalp, this, that, shiny with conditioner, without this thing. And you can safely ignore, there are 16 open-ended fund category in the equity and another 16 for fixed income. You can safely ignore nearly, you just need 3 category of funds.
Okay.
Money for a few days and few weeks and few months should be invested in a liquid fund or an ultra short-term bond fund, and that is it. That takes care of it. And there are benefits of it. It is better than lying in your bank account. If the money keeps lying there for a longer period, you don't have to pay any taxes on the interest accruing in a savings bank account. You have, it is tax exempt till 10,000, and then you are levied, you're liable for taxes. Money for a couple of years, you can actually choose a conservative vehicle. First-time investor, you can choose an aggressive hybrid fund. And if you're a long-term investor, invest in a flexi-cap fund, multi-cap fund, one of these, a fund which is diversified, which is investing all across. Choose one fund, start investing, and when it comes to equity, never invest lump sum.
Okay.
And if you follow these rules, choose these 2-3 funds, do your SIP in long-term vehicles. In your fixed income fund, you can make a lump sum investment.
Okay.
That's all right. Because the whole idea of doing this SIP, doing a regular investing, not investing at one go, is eliminate the possibility of catching a market high. And eliminating the possibility of catching a market high is very crucial for any new investor. Because if you catch a market high, if you get excited about investing when the markets are doing well, which means you have been lured into the market without understanding that what it is, what is the downside, what is the other side of the story. And when you get attracted to the market looking at the recent past performance, then you come with an unusual expectation. And that gets devastated. Because the moment you invest a lakh of rupees or 5 lakh rupees with the expectation that, okay, that some magic will happen and it becomes 4 lakh rupees.
Okay.
And you take your money out and swear that never to come back again. And this happens time and again. And large number of investors come at the fag end of a rising cycle. So it's very important to, how you onboard, how do you start, how do you get going, how do you get, how to start, believing in it.
Okay. So what you're basically saying is time in the market is more important than timing the market.
Oh, absolutely. Long term, I don't know if somebody has, I haven't come across a person, who has become wealthy by having some money, which he invested in a very opportunistic way.
Okay.
And it doubled in a couple of months, and then he took it out and then went to sleep, came back again when it will go up again.
Yeah.
I haven't come across a perfect timer who has been able to time the market and really build sustainable wealth.
Mutual funds help you build wealth, but insurance helps you preserve wealth. Don't just listen to us. Listen to the 7 lakh people who've taken health insurance advice from Ditto Insurance. Even Nitin Kamath backs us. So if you're still not sure, book a free call with Ditto Insurance's IRDAI certified advisors and see how insurance can help you preserve your wealth. Check the link in the description to book your free call.
Got it, sir. So about your own financial journey, right? The wealth that you've built, how much of it, could you just bifurcate for our audience that how much of it is from directly investing in stocks, how much of it is from debt instruments, how much of it is from mutual funds or any other avenues?
Initial few years, rather 7-8 years, I did not invest. I just made that, today that section 80C, and you have investment limit of 1.5 lakh rupees. In the whole of 90s, there was called the equivalent section was section 88A.
Okay.
Section 88 or 88A. And the maximum investment possible in a mutual fund was 10,000 rupees. And I kept doing only that much.
Okay.
I could not save much, but I was actually making equity investment, but it was equity, all my investment, all my profits from the company was getting reinvested in the company.
Okay.
Value research, I own, me and my family owns the company. So we own the equity of the company, and all the money was getting invested there. So I don't have much of a regret that initial 5, 7 years or 10 years, I did not invest. Thereafter, I started investing in mutual funds more regularly because 1996 was the beginning of or rather 93, was the beginning of open-end equity fund. There were no open-end equity fund till 1993. There used to be only closed-end funds, Master Share, Master Plus, Master Gain, Magna Multiplier Plus, Can Bonus, Can Share. So they were closed-end funds. They used to be launched. You put your money and then your money is locked for 7-8 years. If you need the money in between, go and sell in the market. 1993, the beginning of Kothari Pioneer, and it became possible. I think 1996 onward, I started investing regularly in mutual fund. And it carried on for many, many years. And I have invested only through mutual fund till 2008, till 2007 October.
Okay.
After that, so all my net worth was invested and accumulating in mutual funds. And once in a while, I took some money, some 8-10 years back, to buy my house or, some larger capital in, personal spending. But that's about it. All the money has continued accumulating. 2007 October onward, when I launched my stock advisory service, a lot of my customers told me that this fellow is selling us stock recommendation and he does not invest, because I made a policy of disclosing all my investments. On all my analyst report, all their investments is for our subscribers, so that my subscribers should be aware of, all the investments that we are making, and is it in line with what we are saying to them. And so everybody started complaining that you don't invest and you are recommending, stocks. That is when I decided that in the, next 4 years, I'll move my money gradually into stocks. And I started buying a portfolio, building a portfolio of my recommended stocks. So my universe is only those stocks which I have recommended in Value Research Stock Advisor. And I'm very pleased with the performance so far. In fact, I have a mechanism of tracking the performance. So my stock portfolio, based on that portfolio or recommendations in Stock Advisor, has beaten my mutual fund investments. But I've been very methodical in my investments as well. 2007 October onward, I've been investing regularly in that. My incremental investments are in my stock portfolio. My mutual fund portfolio, which I was there, has continued, has remained. I have not liquidated those. I feel that, and I did not invest in stocks in my early years because I did not have the time. Now also I don't have the time, but fortunately I have the stock advisory service, which is forcing me to actually have a curated list of stocks which I can invest in. So that enabled it. And most of my investments, I have only made investments so far. I have never redeemed anything. So even if my money would have, given a 27% return and, it has grown substantially, but I have not taken out unless we make a sell recommendation when I have to sell to be compliant with all the laws that we have to follow.
Okay. So talking about the derivatives bit, right? Like we discussed that, yes, we have a number now that 92% people lose money in derivative trading. But nobody talks about the 8% people, right? And who are they? This is something we discussed. So do you want to maybe use this medium to maybe share more light on who these 8% people are and how the odds are so much against the majority retail investors investing?
Yeah, it's very important to understand that this number of 92% has created the impression that all you have to do is be in the 8%. And the people in the 8% are very different people. They are not folks like you and me who get up in the morning, they're running and doing some trade while in the washroom or while in the middle of our work. No, they are not those people. They are actually doing automated trading. They are looking at those nanoseconds. They are looking at the gaps in the prices when they are actually doing those trades. And they are looking at the derivative market where they see the arbitrage. There are many trades which are done in an automated way. So you have to think that, you are doing with your lowly, 5,000, 10,000, 50,000, 5 lakh rupees trade. And once in a while, it's a leverage trade, market goes up and you make money simply because, you are able to ride the tide. It could be purely accidental. And most rising market creates a false impression of, your own brilliance than the accidental market move. Think of a hen, think of a chicken, and, is picking grains through the day and remains a chicken. And think of a lion who sleeps, king of the jungle, wakes up one fine morning, is hungry, goes for his, for his prey or, for his hunt and gets done with it. Think of, as an investor, you should think of yourself as a lion. A lion who will actually looking at an opportunity, looking at a mispricing or a dislocation of a market, can benefit from it. That is the only thing which, that is where some trade, and if you don't have money, then you are able to build conviction, belief and understanding. And then you are able to put all your energy into it. Rather than, keep working all through the day like a chicken.
Yeah, okay.
And end of the day, you remain a chicken. The magic of mutual fund is that I haven't come across any investor who has done his investment with a 5-year time frame and has ever lost money.
That's true. People tend to lose money even in direct stock investing, but that might
I haven't come across a mutual fund investor who has invested with a 5-year time frame. And not a single investor who has done his SIP. And I know of many investors who lose money.
Yeah.
I know very, brilliant investors or brilliant thinkers, the people who have great perspective, they lose money by betting it wrong. But I haven't come across too many mutual fund investors who have gone wrong.
Do you think when people start their SIPs, they should also think of a systematic exit plan, just like they're doing the SIP?
No, everybody should have an exit plan.
Okay.
And the exit plan is very simple. If it is linked to a goal, you plan to buy your car, you are investing for your car, and when you get to the down payment of the car that you plan to buy, if it has been achieved, take your money out. So if it is a goal linked to a goal, you have an exit plan. The other exit plan is, things don't turn out to be good. You choose a good fund and it turned out to be a bad fund.
Okay.
Now, this is actually a little tricky because sometimes people are unable to differentiate that whether it is a bad fund or whether it is a bad market. Because when the markets go haywire, then everybody feels disappointed. And this is where the understanding comes in. That you have to understand that the fund might have lost 20% and the market would have gone down by 40%. Your fund is exceptional. But you think that, but you are very sad because it has gone down. And that should not be a good enough reason for you to. And when it comes to stopping SIP, when you invested with a plan, I think every investor should think about why are they investing. If they are investing with a time frame, and that is still a couple of years, some time away, then the market fall is a great opportunity. Every long-term investor who is doing his SIP should celebrate that the market has gone down. I would wish that, the market remains depressed. And only when I need the money before that, a year or two before, it starts going up dramatically.
Okay.
That would be the finest thing that can happen to me. Buying cheap and selling high.
So what do you think about these different strategies which are, used by fund managers? There is the growth, momentum, value, contrarian. So do you personally favor a strategy, or do you think a mix of something is what people should use?
All these things work.
Okay.
And all these things work at different points of time. They don't work at the same time. When value works very well is the time when growth is doing very poorly.
Okay.
Contrarian requires a very brilliant, somebody is very perceptive to spot an opportunity, which others, contrarian investing is, everybody in the market thinks that there's a bad investment for this reason. And somebody else thinks that, no, this is a great company and things will actually turn out to be very good very soon. You are thinking, in a contrarian way, contrary to everybody's, the popular perception. Likewise, value. Everybody thinks that, this is something worth, value is very straightforward, something worth 100 rupee available at 80. And, but if something is worth 100 rupee available at 80, then it has to be for a reason. And the reason is very widely known. Somebody thinks that, this is for a reason, but things will turn out to be otherwise. And, what is the situation when things will become favorable for the company? So all these things work at different point of time. Small companies, mid-sized companies, somebody betting on that, or the momentum companies. When you have the biggest belief in momentum is when the momentum fizzles out. So all these things work in a cycle. I would say that the broad strategy is growth and value.
Okay.
The growth investor is normally not a believer of the value. That is what I have learned in my 35 years of, meeting fund managers every few days, is that the growth guy is a completely different animal as compared to the value guy. The value guy can never become the growth guy, and the growth guy can never become the value guy. And rest of the things are in the periphery. I would say that, the value guy, the contra guy is somewhat like a value guy. The small cap guy is generally a growth guy because, smaller companies, being very optimistic about those companies, willing to buy into those stories. So I think, people should focus broadly on value and growth. I think everybody should be a growth investor. Is there in growth as well. If you buy a great growth company at a very unreasonable price, at a very high price, it will turn out to be a disaster.
Yeah.
I know of all the people who got disappointed in the market of 2000. There are people who bought Infosys in year 2000. Next 10 years, Infosys became a 4 times bigger company. And the investor never made money. Investor didn't make money simply because they bought the stock at a price which could not be justified even the 4 times bigger Infosys.
Okay.
So you saw recently, many companies which were trading at prices which was very difficult to justify. In fact, in the Indian market, people explained that strategy, and some of the fund managers who followed that strategy are quite embarrassed about it. And they have been hurt. They have been very disappointing. They made a name for themselves, and it had a good run in the initial phase. And it's a very interesting name called BAP. Buy at any price was the expression used for their strategy.
Okay.
They thought that, here's a great company which is doing very well. But buying at any price is now coming to haunt them. because buying at any price does not work. So there is an element of value needed. Buying something at a, growth at a reasonable price is crucial. Or buying value and thinking that it is value but buying something worthless because it's value for a reason. So there is a subjectivity, there is a judgment call which you have to take.
So over the years that you've been tracking the whole mutual fund industry, who have been some of your favorite fund managers, and what have been some things that they've done that that put you in awe that okay, this is really good?
Well, I've come across all the old fund managers. I've known all the people in the 90s and through the if I list you all the people, some of the people I don't know, they will be very old, or maybe some of them would have passed away. I remember there was one Mr. B.G. Daga, Brij Gopal Daga, who was in the 90s, the looking after all the investment. It was a different kind of fund company where he was keeping an oversight on a large number of funds. So I used to listen to understand some of his initial hypothesis, and it turned out. And UTI was one of the biggest investors in the public sector companies in the early 90s, and was the single largest buyer of the bundle lots of the public sector stocks which were sold by the government. So somebody like him, or the Mr. Kapoor, M.M. Kapoor, who passed away post the Great Indian Scam. So they were very early days when there was dearth of information, or not the fund manager but some of the brokers I've come across who were very were brilliant. And of late, there are quite a few. I think nowadays you have a large number of mutual fund managers. I've known, Kenneth for a long time, or, had admired his strategy and it has worked very well at a certain phase. Or Prashant Jain, initial 15 years were brilliant. And I've seen, the courage of conviction. Or Bharat Shah of ASK, in his early Birla days. So I've come across many fund managers whom I still recall by their face and can relate to. So the market has changed very dramatically. But I think the basics of long-term investing, the value, growth, and decoding a company, betting on it, living through those things, living through lean times, has not changed at all.
Okay. So do you see any fund manager or their strategy playing out in India that you feel is just as par as their global competitors? Do you feel that?
Oh, I think, most Indian fund managers, because we look at international funds very closely, and quite a few of them in Europe and America. So I would say that the Indian fund managers a large number of Indian fund managers are far more ambitious and, are more are able to take measured risk and be right about it. Because when I look at, the global investing scene, the fund managers, they work in a very structured operating framework. Majority of the funds work in a very structured operating framework where they comply with, the focus on compliance in terms of portfolio construction and the variance with the index in a narrow range makes it very rigid. Indian fund managers, I find them to be very imaginative. You will come across fund managers who are able to they will have a benchmark, but they will have no resemblance with the benchmark. So I'm much more impressed with the success and the demonstration of courage by the Indian fund managers than globally. I'm not very much, I'm not enamored by that, okay, this is a global thing. I think the global thing, global fund management, there are far and few who are admirable.
Do you feel active investing is better or passive investing is better, or is it relative to how the market is going?
I can tell you with conviction that if you are going to invest in a Nifty or the Sensex fund, which are the bigger ones, which are the popular ones, they are the big ones. And all other index funds are relatively new. I would say that, these funds will be beaten by a multi-cap fund or a flexi-cap fund by a modest margin to a wide margin.
Okay.
Over the next 10 years.
Okay.
So, but In between, if you are going to feel very sad about unable to beat the index, then might as well buy the index.
Okay.
Because there will be period in this 10 year when this fund will not be able to beat the index. And the reward of that will be the outperformance over the 10 years. So if you want to match the index, buy the index.
Yeah, okay.
And if you want to beat the index and can stick around for 10 years, then buy the actively managed fund. Now, there's a twist to the story that we only had the Sensex and Nifty fund. Now we are getting mid-cap fund, a variation of fund, the momentum fund, or wide variety of index fund. I would say that if you combine a Nifty and a junior Nifty and a mid-cap index and a small-cap index, that will be the right benchmark to the flexi-cap fund. And I think by combining these things in a certain ratio, which is as simple as 10% and 20% and like 70% here, or 40% in the junior Nifty and another 30 in the Nifty, this will make it your 100% money. And if you invest in such a fund, 4 funds of different caps, that will be reflective of the multi-cap or the flexi-cap fund. This fund will actually very likely to get you about 80%. And maybe beat the actively managed fund as well. And if you have to really invest for the long run and you don't know which one to choose, then resolve that excuse, invest in an index fund till you are able to learn.
So what do you think about commodities like gold, silver? Should people think of them just as hedges or stores of value, or seeing the run-up of gold recently, right? Like gold has outperformed Nifty Sensex in just the past year. Or should they consider these commodities as serious investments and put a large chunk of their money here?
I've been wrong about gold for a long time. I've always said that it's a store of value, and it should not be. It's not a productive investment. It's when you buy a stock, you are buying the underlying company.
It's not yielding. Gold has no yield.
Yeah, it does not yield. When you buy a house, it gets you a rent or you save on the rent. You lend your money, you earn some interest, and somebody else is putting it to, some productive use. That is why you get rewarded with that interest. But I've been wrong because ever since this, central bankers started buying these gold, we have seen the run-up. So there are 2 things which is, which has turned out to be very favorable for gold. One is that, maybe 3 things. One is that it's the only store of value which has the longest history, much longer than what, our modern financial system is. Gold has a documented history of 5,000 years, that it is a store of value. People used to exchange in terms of coins or as a something worthy of exchanging with other things. So gold plays the role of a currency which has the longest history. Then comes, the financialization of gold, which happened sometime in the mid, 2005-06, it happened, and which was followed by the global financial crisis, when there was panic in the market of an unprecedented kind. We saw the big fall. We saw the big fall of the fund. There was a crack in the financial system.
Yeah.
The decline and the fall of the, large investment banks in the US. And that is when we saw that there was a one-way run towards gold. And investors' ability to buy it in the financial form, without owning it, without actually worrying about preserving it, keeping it in the locker, turned out to be very handy. So this financialization, and now comes this central bankers using it as a currency, because the de-dollarization, to call it, because what happened post-Ukraine, that many of the dollar-denominated assets of Russia got, nullified and or got confiscated, and then that actually led to the thinking that it might be worthwhile to spread beyond dollar, and and it's very difficult to go beyond dollar because most global trade is dollar denominated. But what happened, we are seeing an unusual surge in the holdings of the central bankers owning gold, and good till it lasts. And because it has done, it is something which is completely uncorrelated to equity and debt. One should have some a part of it in it. In it, this is where I have changed my mind.
Okay.
Initially, I used to say that just buy jewelry and feel happy about it and never invest in gold, because I have been proven wrong and all these variables have changed, and also equity and debt becomes extremely volatile, unpredictable on many occasions. So having gold might be useful, but I still don't buy into the whole concept that okay, you should have 40% into gold. No, have 5, 10, 15% at most.
So if you are to say help someone in their 20s who has just started building their portfolio, what are some 5 things that they necessarily have to check when they are picking a mutual fund?
Investing for next 10, 20 years, I would say that consider a small and a mid cap fund. If you will not get unnerved by the ups and downs, and do only SIP. Never invest lump sum. And first 3 years, don't look at the value of your investment. If you are able to follow my advice and follow it to the T, I think, you will end up being a winner.
And how do I pick this fund, this small cap and mid cap?
This is pretty straightforward. Many people actually ask me that how they should pick the fund. Go to Value Research online.
Okay.
Look at this category of funds. You will get a listing of all of it. Look at the alpha, and anything with a nominally positive alpha over a 5-year period, or a fund which has beaten its benchmark over 3-year and 5-year period, that is it. If you will get in a category of 30, 35, 40 funds, you will be able to narrow if you have spotted the category, you will end up with a limited number of 4 to 5 funds. Choose the one which you like. I don't know which of these ones will actually do well, but the fact that over 3 or 5-year period they have been able to beat the benchmark by a modest margin. What I would like you not to ever do is that don't look at last 1 year performance and chase the winners.
Got it. And do you think the current time of the market is a good time to invest?
Not only current time, it is always a good time to start.
Okay.
Because you should be doing your regular investing. You should never be investing lump sum, and more so to begin with. So it is always a good time make sure that you are investing for 5 years and more.
Got it. So you also spoke a lot about investing in foreign companies, how if it were up to you and there were no restrictions, 15% of your wealth would have been in Indian stocks and rest,
I'm just guessing. It could well be 100%.
Okay.
So, who knows? Because, then I will be completely guided by the merit of the investments.
Okay. Got it. So a significant amount of your wealth would have been in foreign.
I will not be differentiating. There is a possibility that will be an occasion when most of the money could be in India.
Got it. Understood. So it just shows that you have a lot of conviction for investing in foreign markets as well. But what can a retail investor like me or someone who's watching this video do? Should they maybe go to invest through these platforms that have recently come up through which you can invest in foreign markets? Or should we maybe start investing through mutual funds that, invest in foreign markets?
There are 4 or 5 vehicles through which you can invest. There are foreign funds, foreign ETFs available to Indian investors. But unfortunately, most of the vehicles available through mutual fund, whether it be ETF, a fund of fund, or an actively managed fund which invests abroad, all these vehicles are available. Some of them are still open, but most of them are closed because there was a ceiling of how much money these funds can invest abroad, and RBI has put a restriction on that. The Indian mutual fund industry has hit that ceiling of $7 billion or so, and there is a separate ceiling for ETFs. They are close to hitting that, or they have hit that as well. That is why you don't have you can't buy this FANG Plus or the Nasdaq funds, which was earlier possible. But as and when it becomes possible, I think these are the safest vehicle. Because why? Because you are getting a diversified vehicle. Second, you are getting a regulated vehicle, regulated by the Indian regulator, and I really admire our Indian regulator so much more. I have a recourse. I don't know what I will do if something which is when I invest abroad, and it is regulated by a regulator, SEC, for example, in the US, and I'm investing through a broker who is domiciled in America. Then something goes wrong. Where do I go? How do I deal with it? Accessing it, I don't know whether my lawyers will be able to, deal with that. They may not be conversant with it. Here I know that, okay, here is a fund company which is selling a mutual fund. I have invested. I put my rupee. It's also very cumbersome to invest abroad through a broker. You take your money, open a brokerage account, move your money to a broker's account, and first the bank will charge you to turn that rupee into dollar and credit there. Then when you get back, you have all these tax headaches. The money went out and it is coming back, and what was the nature of the gains? Did you do some short-term gains created in the broker's account? You will have to clarify all that. In case of mutual fund, it's so simple. Put your money, take it out, and during the period, Indian mutual funds are even more beautiful than the funds abroad. You are not liable to pay any taxes except when you sell it. And if I invest my mutual fund and take it out after 10 years, I don't have to bother for those 10 years in between. And I'm not liable to pay any taxes. Fund manager can do whatever he wants to. He might be generating all the returns, which is short-term gains. It doesn't bother me at all.
For you, it will just be the long-term capital gains when you sell.
That's it.
So what are some red flags that when somebody is investing in a mutual fund, what are some red flags that they should notice, and if they see it, they should not invest it?
Oh, quite a few. One is that, long-term performance is not good enough. Why get into that area? Okay. Somebody has proven that he has not done well over the 5-year, 10-year period. He might do well, but who knows? Then don't buy a new fund. Then consider, don't buy anything exotic. Because not that these exotic funds don't do well. They do well. But mostly, and never buy a thematic or a exotic new fund offer. Simply because odds are against you. Mutual fund is a consumer product as well, besides being a financial product. And that is why, a sector or a theme which has done very well becomes a good story. And today everybody will be telling you that these defense stocks are such a great theme. Look at this, what is happening to Hindustan Aeronautics, and what is happening to Bharat Electronics, and this Mazagon Dock and Garden Reach. And if you look at it, what it will hide is that they did the waiting for 10 years and nothing happened. And then last 2, 3 years, 5 years, it started doing well. Then some good things happen to these companies, and they're doing reasonably well. They come with all the risk. The biggest risk with all these companies is that, these are government companies and all their customers are also government.
Government, yeah.
So when I look at it, but if it has done exceptionally well in the last 2 years, 3 years or 6 months, we tend to get carried away. And these funds get created only when it becomes very tempting for somebody to buy it, and which is normally a peak. So most of the time I find that, too good to be true, it turns out to be not true. And when it is not true, you get trapped and it turns out to be, injurious.
Got it. So that is second. Don't buy funds that have not given good performance in the last few years. Don't buy funds which are specific thematic, thematic sectoral ones. Yeah. And what else, sir?
I don't like any concentrated things. A fund which is very narrowly led. So a sector or a thematic fund will fall in that category. Even a strategy where very few stocks dominate the portfolio. I will be wary of it, because I will, as a mutual fund investor, I would like to have the option of, I will be willing to compromise on some exceptional return for sake of greater stability. And that can come only with, little broader choices. So, and one most important thing which is actually a starting point, actually I don't look at a fund. If it happens to be, I look at the expenses. Everything else being equal, expense is a constant. If the top quartile, low cost, of the direct plans turns out to be, 50 basis point, I think a 75 basis point expense ratio is 1.5 times more, and it will reduce my return. So everything else being equal, look at the lower cost.
Okay. So now let's
And
specify.
one more thing which
Yeah.
crosses my mind, that when I look at this performance and the alpha and the relative performance beating the benchmark, I also see that fund manager is still around, because he is the most important person driving all of it. So all of it is there, but the fund manager has disappeared. It's not good enough. It's a big red flag if a great fund manager disappears,
Okay, got it.
goes away.
Got it. So now just specific metrics that somebody can use when they are, picking a mutual fund. So should they look at the Sharpe ratio, the alpha, how it has performed as relative to the benchmark, etc.?
I think looking at information ratio is good enough, because it's actually reflective of all this. And what at Value Research, what we have done is we have our own rating system, which is a risk adjusted rating. What we start with is first drop our rating system works beautifully. It is very consistent. It is a quantitative measure. It is a quantitative measure of the risk and the return, adjusted return of all funds in its category. So my first exercise is elimination, not selection.
Okay.
Narrowing my universe of choice is the first step. So all I do is drop the 1-star and 2-star fund, and sometimes the 3-star fund as well. So my starting point is 5-star and 4-star fund. At least it has a demonstrated track record of delivering superior risk-adjusted performance over the last 3 and 5 years. That is my starting point. Then comes looking at any other variable. Then if you actually drop some by expenses and some by I think most of the superior performing fund or the funds beating the benchmark will be captured here.
Okay. So any last message that you want to give to our viewers so that they don't fall into the pitfalls of the market?
Keep it simple. Okay. Save. Earn. Most important thing is earn.
Okay.
And try and save. Try and resist the temptation to be impulsive spender. And if you do this, then you will end up saving. And before if you earn, before you start spending, make your investment.
Okay.
And do it for 3 years. Do it in any fund that you like. Do it in an index fund. Do it in a mid-cap fund. Do it in a small-cap fund. Do it in any fund. And don't look at it for 3 years. If you are upset about, if you can't choose a fund, if you can't invest in a fund, do it in a recurring deposit. Because, investors, somebody needs to, when you have no money, somebody needs to really understand that converting small sum of money into a meaningful capital. This will translate into, something like six months or 1 year worth of your earnings in 3 years' time. Then that compounding at a higher rate. And this initial learning, if it is demonstrated to you, you don't need to learn anything more. Just be at it over your lifetime, over the course of your life, and keep increasing your savings, investments as your income grows.
Okay, got it. Thank you so much, sir. Thank you so much for taking out the time and speaking with us.
Thank you so much for watching this video. Do let us know what you think about this in the comments. See you on the other side.